Silver futures hit $1.25 billion in volume on a crypto DEX. Something wild is happening right now on Hyperliquid. Yesterday, silver perpetual futures did $1.25 billion in trading volume on a decentralized exchange for a commodity. To put that into perspective, silver is now the third most active market on Hyperliquid, sitting behind only Bitcoin and Ethereum. It's trading more volume than Solana, more than XRP, more than basically every altcoin. Here's why this matters. Hyperliquid launched something called HIP-3 back in October. It lets anyone create permissionless perpetual markets by staking HYPE tokens. So traders created silver perps, gold perps, copper, natural gas, even Forex pairs and equity indexes. The trading fees from these markets get split 50-50 between Hyperliquid and the market creator. The exchange's portion goes straight into an assistance fund that buys back HYPE tokens from the market. More volume means more fees, and more fees means more buybacks. It's a self-reinforcing flywheel. Hyperliquid CEO Jeff Yan posted on Twitter yesterday that the platform has quietly become the most liquid venue for crypto price discovery in the world. He noted their Bitcoin perpetual spread is now tighter than Binance. The open interest across HIP-3 deployed markets just hit $790 million, a new all-time high. What we're watching here is crypto infrastructure being repurposed for macro trades. Traders want exposure to the so-called debasement trade. Next up, Moonbirds. Moonbirds is launching their token today, the Birb token, and if you've been in NFTs for a while, you will remember Moonbirds. The pixelated owl collection launched by Kevin Rose's Proof Collective back in 2022. $280 million in trading volume in the first 2 days. Then the NFT market collapsed and Moonbirds went quiet. Yuga Labs acquired the project in early 2024, but didn't do much with it. Then Orange Cap Games bought the IP last May, and now they're making their move. Today is the token generation event for the Birb token on Solana, and here's what's happening. Orange Cap Games positioned Birb as what they call a culture coin, part meme identity, part on-chain infrastructure. It's designed to support governance, staking, ecosystem incentives, and future integrations across Solana. The token has a total supply of 1 billion Birb. Holders of Moonbirds NFTs, including Mythics and Oddities, can claim soulbound tokens tied to their ecosystem participation. And here's the institutional signal. Coinbase added Birb to their official listing roadmap last week. Historically, that kind of announcement has been a strong catalyst for emerging tokens. Orange Cap Games CEO Spencer Gordon-Sand said that the goal is to become the Pop Mart of Web3, building a multi-billion-dollar consumer brand through physical collectibles, gaming, and token economics. The launch follows a 24-hour community event called the Birbathon in partnership with Solana. What's interesting here is the playbook. Take a dormant Ethereum NFT brand, move it to Solana where transaction costs are lower and meme culture thrives. Launch a token, target mainstream consumer engagement rather than just NFT collectors. We've seen this work with Pudgy Penguins and Pengu, Azuki with Anime, Doodles with Dude. Now Moonbirds is running the same play. Whether Birb has staying power depends on what Orange Cap Games builds next, but the infrastructure is now live. Next, we move on to Avalanche ETF, and Van Eck launches the first US ETF with staking rewards. Wall Street just launched something new for Avalanche. On the 26th of January, Van Eck's Avalanche ETF started trading on Nasdaq under the ticker VAVX. It's the first and currently only US listed product focused on Avax. But here's what makes it different from the other crypto ETFs. VAVX isn't just spot exposure, it also includes staking rewards. The fund will stake a portion of its Avax holdings through Coinbase crypto services. Those staking rewards accrue to the fund to get reflected in the net asset value, so investors get both price exposure and yield generation, all through a standard brokerage account. Van Eck is waiving the sponsor fee on the first $500 million in assets until the end of February. After that, it's a 0.2% annual fee. Kyle DeCruz, Vanex, Director of Digital Assets, said that Avalanche's architecture is uniquely positioned to bridge the gap between traditional finance and the on-chain economy, focusing on verifiable, real-world utility. So, why Avalanche specifically, and why does it matter? The network has been quietly building institutional infrastructure. Wyoming launched its Frontier stablecoin, the first state-issued stablecoin, on Avalanche early this month. Galaxy Digital completed a $75 million tokenized collateralized loan obligation on the network. BlackRock's Build Fund and Franklin Templeton's FobXX Fund both expanded to Avalanche too. The DeFi total value locked on Avalanche hit over 91 million Avax through 2025. The network's subnet architecture lets enterprises build customizable blockchains that still connect to the main Avalanche ecosystem. What this ETF signals is a shift in how institutions think about altcoin exposure. It's not just about holding the asset anymore, it's about accessing the yield mechanics built in proof-of-stake networks through regulated, familiar investment vehicles. Next up, Infinex. Infinex is about to launch their token on the 30th of January. And if you haven't heard of Infinex yet, pay attention, this is one of the more ambitious DeFi projects heading into 2026. They call it a crypto super app. Think of it as a unified interface that aggregates liquidity from spot dexes, perpetual protocols including Hyperliquid, and other on-chain markets. Swaps, bridging, yield generation, derivatives trading, all in one self-custodial platform. The goal is to make DeFi feel like a centralized exchange. Simple, fast and intuitive, but without giving up custody of your assets. Infinex supports over 20 blockchains. They've built gas abstraction so users don't need to worry about native tokens for fees. They've integrated everything from NFT marketplaces to prediction markets to airdrop claiming. The public token sale just closed. They raised over $7.2 million from 868 participants, 5% of the total token supply. All tokens from the sale are locked up for 1 year, but there is an early unlock option that starts at a $350 million FDV and declines linearly over 12 months. What's notable about Infinex is the team. They came out of the Symphonex ecosystem. The project raised nearly $68 million through their patron NFT sale back in 2024. Thesis here is that DeFi users' experience problem is solvable. Most people don't want to manage multiple wallets, bridge assets manually, or hunt for the best swap rates across 20 different chains. Infinex wants to abstract all of that away. Whether they execute remains to be seen, but the infrastructure drops in 2 days. Tomorrow, the SEC and the Commodity Futures Trading Commission, or the CFTC, are holding a joint public event to discuss crypto regulatory harmonization. This is a big deal. Let me tell you why it matters. SEC Chairman Paul Atkins and the CFTC Chairman Michael Selig will appear together at CFTC headquarters in Washington. For years, crypto projects have been caught between overlapping and sometimes conflicting interpretations from the SEC and the CFTC. Is a token a security? Is it a commodity? Both? Neither? The answer often depended on which agency sued you first. The joint event signals an end to that ambiguity, or at least an attempt on it. They're specifically planning to discuss frameworks for DeFi, tokenized real-world assets, and perpetual contracts. Under Paul Atkins, the SEC has already launched something called Project Crypto, promising innovation exemptions and clearer token rules throughout 2026. The CFTC has been running a crypto sprint since August, piloting tokenized collateral like Bitcoin and USDC. Meanwhile, the Clarity Act, which would formally divide oversight between the SEC and CFTC, is still pending in the Senate. Banking Committee Chair Tim Scott confirmed a January markup session, with a floor vote expected in the first half of this year. Clear, workable rules from both agencies could unlock institutional capital that's been sitting on the sidelines waiting for regulatory clarity.